Hi there, and welcome to this lecture. In this lecture, we're going to start the module by covering the regulatory infrastructure from a UK perspective, but we're going to first of all start with talking about regulations in general in part 1. So, what are the learning outcomes of this session? Well, we're going to talk about the principles-based versus rule-based regulation to start with. And this is an argument that we'll explore throughout the first week of this module. We'll talk about how we've made a shift from principles-based regulation to more rules-based regulation and the arguments for that. Then we'll go into a bit more detail specifically about the UK context with the Financial Conduct Authority and the Prudential Regulation Authority. Explain the differences between them, who are they, and the different roles and responsibilities. And we'll broaden that out to talk about different regulators around the world. And then finally, we'll talk about the purposes and applications of the standards that they set in the context of the financial services sector. And this will hopefully lay some of the foundations for the rest of this module when we start talking about the markets and the players within that market. But let's start with a rhetorical question. And we'll talk about this in the context of principles-based versus rules-based regulation. So rules-based, effectively, these are the rules. Principles-based, or this is the guidance, this is kind of the standard set, play in line with them. So in the context right now that we're sitting in, that you're watching this at your remote location due to social distancing. Now, what is social distancing? Is that a rule or is that a principle? Let's look at it one way. You've seen the slogans, hands, face and space. Well, surely they're principles, right? They're not rules, they're just principles. We have to kind of adhere to that slogan. But what I'm told to wash my hands before I go in anywhere using a sanitizing station, is that a principle or is that the rule? Sometimes I go to the supermarket, walk straight past that sanitary station. I might get a heavy touch by someone, but am I breaking the rules? Well, I might not be, because it's a principle. However, some places, they'll stop you at the door, they'll put sanitization stuff on your hands already, and they'll take your temperature. And that's because they've set rules for their own store. So, is this hand, space and face, is it a principle or is it a rule? Well, in my view, it is a principle. However, individual authorities, like a superstore or hairdressers, may apply them as specific rules. If we think about the university when you come onto campus, we have the principles, but you'll have seen the university have supplied a list of rules that we must adhere to. So it's an interesting argument. Is this whole concept of social distancing a principle or is it a rule? I suppose that depends on the overarching body that's enforcing them. If we think there's now been put in place certain rules that if we break, there's a penalty. So that's quickly turned the principles into a rule that's enforceable. And the population are more likely to follow rules that have enforcement. Otherwise, they might just not bother. So, I'll create a rule right now. If you haven't watched this video, you can't attend the face-to-face session or the seminar for the coming weeks. Now, Have I any means to enforce that? Is this rule fair? You're probably sitting there going, well, you're watching it, so you're fine because you're watching this. But if I told somebody that hadn't watched this, well, I made that rule in the video. Well, they'll go, well, that's not fair. I didn't watch the video, so how will I know this rule exists? People that are watching this video might think, well, that's not fair. My friend might have not watched this because they didn't have access to it. The internet wasn't great. My thing, I'll come back and say, well, rules are rules. That's the rule. I've created it. So if you haven't watched this, don't turn up. So what we're arguing here is, are rules actually rules? Do I have any means of enforcing that? Well, technically, I can see who watched this video. But am I going to stand there with a clipboard and pen and go, well, you didn't watch this video? I haven't got time for that. So we're kind of going from, if we're debating this, we're going from my rule, pretty black and white, if you don't watch this, you don't come, to a bit more of a grey area where excuses come in place and I have no powers to enforce it. And I have a belief that, well, you know, it's your education, I want you to be there, I'll catch you up, I'm a nice person. So even though I created this rule, I can't enforce it. And my ethics will tell me, no, if a student turns up, I'm going to allow them to be here, because they'll still be able to contribute somehow. And they can learn from their peers. So there was absolutely no point in me making that rule in the first place. So I hope you get from that example, there's a lot of blurred lines. And this is kind of like a metaphor for your education experience right now. Now you're in level 5. Level 4 was a bit more black and white, quite definitions based. That was my cat kicking off my keys and my AirPods on the floor. Cheers for that, Pablo. You've moved from level 4, which are definitions based, but now we're in level 5. I want you to think and critique and be more critical. And this is where you go from black and white to grey. So this is what we expect throughout the rest of the module. Is quite a lot of rhetorical questions. And then there might not be an answer, but I want you to critically evaluate and try and find the answer. So it's not as black and white as level 4. And again, as you get to the final year, it will build and build. So, what is regulation? Well, in this slide you can see the definition. A rule or directive made and maintained by an authority, or could be the action or process of regulating or being regulated. Okay, well that's a bit vague. Let's think, who makes the rules? Who actually makes them? Who makes the regulations? Why did they make the regulation? What regulation did they make? What's the purpose? And lastly, are they enforceable? So let's think about a regulation. We'll think about one that's in law. So driving. The speed limit's 30 miles an hour. Now, why is that? Who created that? Well, there was a lot of research, I'm assuming, about safety and standards and the impact of a crash at 30 miles an hour, and all that's been put together, and then a regulatory body or a government has created this law that was put into law by a head of state potentially. So that's the regulation. The speed limit's 30 miles an hour. Right. So I'm sitting outside or approaching a school, and the school is breaking up. Everyone's outside. Shall I still drive 30 miles an hour? Shall I see if I can get my car from 0 to 30 as quick as possible? Because I'm not breaking any regulation, am I? But in society, is that fair? I have to think to myself, well, what's the enforcement? I'm not breaking the law. So if I go up to 30 miles an hour right now, I can't be prosecuted for anything because I'm within the law. That's true. But society will tell us that it's not a good thing to go from 0 to 30 right outside of school when kids are just getting out. And I can imagine you can understand why. So we might have regulations, but it's all about personal choice, ethics, and public interest. Whether we follow them to the letter or whether we use this kind of grey area. So as we're in level 5 now, we're going to use more literature definitions. So this definition here is from the textbook on the screen. However, there is a paper from Julia Black in 2002 called The Critical Reflections on Regulation, and there's a really good definition that is used, and this is in the context of problem solving and goal seeking reasons. So you think regulation, well, the idea of regulation is potentially to solve a problem or to create a desired outcome for society. So a definition here is regulation is a process involving the sustained and focused attempt to alter the behaviour of others with the intention of producing a broadly identified outcomes. So I'd highly recommend that you try and find this paper. It's easily accessible online. I can put it on Blackboard, but it really talks about regulation, and it's reflecting on the various different aspects of regulation and whether it can potentially survive. So I'll put this paper on Blackboard for you to have a read in your own time if you'd like. So let's talk about who makes the regulations and what regulations are we talking about. So if we think in the context of a capitalist society, just like we have in the UK, who makes the rules? Well, firstly, let's talk about what is a capitalist society. So in a capitalist democracy, we have to have 3 different agents. We have the government, we have the law courts, also known as the judiciary, if I can say that properly, and lastly the market. So in a capitalist democracy we have the government, the judiciary, who should be independent, and the market. Now let's think about the concept of judiciary independence. So these are the lawmakers. So a brilliant example was probably this time last year when in the UK Boris Johnson in government at the time wanted to prorogue Parliament before creating a new Queen's speech. Now that's the government, and their argument was we haven't had a proroguing of Parliament for a while. It's normally the rule before a Queen's speech, therefore I'm going to prorogue Parliament following these rules. But there was a legal challenge which was took to the High Court, and the High Court turned around and said, well, okay, this rule of you have to prorogue Parliament before Queen's speech, that's correct. However, that was more of a principle or kind of something that had just always happened. And then came back and said, well, actually, by law, this proroguing of Parliament is illegal. So told the MPs to get back to work. Obviously, the media and the public might have kicked off at the judiciary for that, but the judiciary was basically using the law, the black and white, and it was an independent view. Let's fast forward to today. As of yesterday, making this video, In the US, Donald Trump has announced his nominee for the Supreme Court in the US. But is this judiciary really independent? If you have, well, now it's 8 at the moment, but someone else has been nominated for a 9th. But these are politically appointed people in the Supreme Court. So, are these technically independent? Because if the person in government at the time can elect a representative to be on that court, is that truly independent? Now, I'm not going to give you an answer to that because it's of you, but I'll let you have a look at that in the news right now and then make up your own mind. So, going back to the concept of a capitalist democracy, we've got the government, the court, and the market. So, let's talk about a free market. This is a market that doesn't really have any sort of rules, regulations, and it really just lets, by convention, the market to do its own thing in order to achieve the goal of whatever that market is. And just to put some context, if we think about the spectrum, you have like the free market at one side, and on the other side of the spectrum you have the planned economy by the government. We'll say that the former communism bloc basically is kind of the other side of the spectrum here. So, do we need regulation in a free market? Well, the likes of Milton Friedman, the American economist, who believed in free markets, will say, no, not really. Let the markets run. But does that work? If the market was free and you went to the supermarket and that supermarket sold you rotten apples and chicken or some sort of meat that had no welfare standards, would you be happy? You probably wouldn't buy that because for your own health. So in a free market, you have the choice to go somewhere else. So you'll go to another supermarket and then potentially see what they're selling you. But what happens if that other supermarket is doing exactly the same? Because they don't really need to compete. If everybody's doing the same standards, then that creates a monopoly. Well, that's not good. But what if the other supermarket did actually look after its food with certain welfare standards? Then you'd probably shop there. And then that would quickly close down the other supermarket because everyone would go to this new one that's doing things better. So the purpose of regulation potentially wouldn't be needed because the market will work out how to sell you good products. Therefore, the other supermarket would have to change and try and also sell you good products. And that wasn't wrote in regulation. That was just the market deciding that people want apples that aren't rotten and want to eat food with good welfare standards. So in a free market, that would work. But in our capitalist democracy society, we know that we have high food standards. And they're actually standards, and some of them are, in fact, law. Certainly when it comes to animal welfare, there is laws in place. So, were we actually talking about the free market in the first place? Well, I don't think we were. We were talking about something that we thought was a free market, but in the context of a capitalist democracy. So it's as free as it could be, but not free of regulation. But going back to the slide here, the likes of Milton Friedman would say, well, a free market would achieve efficiencies in a prosperous economy, and it would maximise consumer choices. Well, that's true. Unless, go back to that example, it then starts to create a monopoly because the market wants everybody to have good apples and good welfare. So it could actually create a monopoly if everyone's doing the same, or if one of the companies that didn't just disappeared and then you'd only have the one supermarket that provided the good products. That could create a monopoly. So that wouldn't really be a free market. So it's about as free as it can be. But there's not really many examples of free markets. In the UK, do we have a free market? I'll tell you some easy examples. If you're walking home late at night, you have a choice of two streets, both the same distance. One has lights and one doesn't. Which street are you going to walk down? Chances are you're going to walk down the one with the lights. But if we're on a free market, who's paying for them lights? Are you a taxpayer? On a free market, you're probably not. So who's paying for the lights if there's no tax? So you go, okay, fair enough, we're in a free market, therefore I'll walk down the street with no lights. Now, if something happens to you on that street, unfortunately, you're mugged. Who are you going to complain to? In a free market, the police exist. Because who pays for the police? There's no taxpayers. Essentially, in a free market, there isn't some sort of enforcement. There isn't any sort of policing. So when we talk about a free market, it's a free market in the context of a capitalist society where there is some sort of law enforcement, or an army is technically the old speak. So we're not actually free under capitalist kind of democracy, but it's about the extent of how free we are in creating regulation. Let's just look at some of the kind of textbook definitions here on kind of the skeptics about the views. So let's think about regulations, certainly law, statute regulations. The kind of skeptics, they get in the way. We've all been there. There's some rules that, quite frankly, get in the way. Red tape is what we potentially call it. Some people would argue right now there's far too much red tape, certainly when it comes to social distancing and one-way systems. And there was an argument about this when it comes to going back to work. So when in the UK we were told to go back to the office, well, some officers were saying, well, no, stay at home because there's too much regulatory cost for us to actually get you back in the building. You're better off staying at home. We can't provide all of these rules, so just stay at home. Because some businesses did see all this extra social distancing measures as a regulatory burden. So they worked out it'd be more efficient to keep their employees at home. And that makes sense. Because it does increase the cost of business. You could argue that some things really mean businesses can't actually operate. I've got an example of kind of regulatory burden on a bank, an unintended regulatory burden. And this is from Goldman Sachs. So 2 years ago, they came into the UK market and created a savings account called Marcus to try and get their first step into the UK. And that's who I currently have a savings account with. Now, last night, I got an email saying my interest rate had been lowered from 1% to 0.7. Now, it's not the first time it's happened this year. And on the face of it, you're probably thinking, oh, well, interest rates in the UK have been dropped so low, therefore they're just reflecting the market. Okay, I'll buy that. But actually, if you dig into what actually happened, is their savings product was too attractive. So the UK regulator said, yep, you can have you can come into this market, but you can only have a certain amount of savings. If you go above this level of savings, this new regulation kicks in about the ring fencing, which you may have heard about, and we'll talk about at some point during this module. So if you get so much capital, therefore you have to start ring fencing it and make it a separate entity from your investment arm. What's actually happened is this savings account got very popular because it had good rates. So what the bank now essentially are doing is preventing new customers by offering a not a very attractive rate, and its current customers, it's kind of lowering their savings amount, the rate that they give on savings, because as they edge closer towards this kind of regulatory ceiling, then that instantly switches something where the bank has to do even more regulation, and this would actually be a massive cost, and it would alter the whole business structure of this product. So that's one example of a regulatory burden, and it would prevent how this bank actually operates. So that's kind of a big skeptical view from a finance example. So I thought it was quite interesting reading that, because I generally thought it was because interest rates were dropping, but it's actually not. It's because this product's too good, and the savings account, they've got too much capital, and they don't really want to change the whole business model because of the extra regulation of ring fencing. So I wouldn't be surprised at some point in the future they might kind of go, you can't actually put any more money in, but we'll see how that pans out. But I'm slightly annoyed that my savings account interest rate has dropped a bit further, but never mind. But obviously there is issues of having no regulation, as you can imagine. Let anyone do what they want. Certainly in an economy. Historically, certainly during the Industrial Revolution, there wasn't any regulation when it comes to negative externalities, the unintended consequences such as pollution and things like that. So if you let people get away with whatever, you'll potentially create excess pollution. You might create monopolies, and it could become a very crime-ridden, lawless state if you were to have no regulation, no enforcement. And obviously we wouldn't want that. Now, we also have the concept of self-regulation. And there's big arguments for self-regulation. If the market knows what they're doing, it's their market, they know how to regulate it. But you have seen this terminology on the screen of window dressing, making it look good, but really underneath it's pretty corrupt. And there is some industries that are arguably self-regulated. So we think in the UK, the alcohol industry. The industry itself is quite self-regulated, certainly in the bar context. Now, obviously, there's rules that are governing the industry, but within it, it's quite self-regulating. The gambling industry, also pretty self-regulated, but you'll have seen recently there's been laws put in place to have maximum bets. So that's kind of the government going, add on this concept of self-regulation isn't working as such. And what I mean by self-regulation is, think about these two examples. What do they have? Well, they have set up to a principle of gamble aware or drink aware. And you've got that whole them organisations kind of within that industry. But who pays for gamble aware and drink aware? The industry itself pays for it. Now, obviously, because of social pressure, it's there for good reasons. But a cynic might go, well, their bodies by the funded by the players in the market, then is it really independent and are they really working? Because the industry might fund these two bodies to protect people, but is it really protecting them? Do we really need to have laws to start helping the industry protect its customers? And that's what we did see when they put a maximum bet on the fixed odds terminals in gambling. The government realised some of this self-regulation was not working. So to finish this session, this video, why do we actually regulate? Well, as you can see here, it is to meet public interest. Right. What does that mean? What does the public interest mean? Who decides what the public interest is? Well, we do. But let's use some examples. Do bankers deserve big bonuses? Now, let's ignore the fact that it might be it might be in their contract. Okay, we'll ignore that. We'll say these bonuses are discretionary. Some might say yes. It's not breaking the law, is it? There's no law preventing bankers to get bonuses. But let's think about what's actually happened recently, going back to 2008. Large bankers' bonuses were quite an argument for reckless behaviour, moral hazard. You might do a lot of harm in the market in order to get your bonus. Okay? And that's what people would argue happened. And therefore there was quite a lot of media and public pressure on to stop paying bankers' bonuses. But the banks will say, hold on, why regulate this? But I think really society has regulated this, and there's been a lot of public interest in bankers' bonuses. Beforehand, there probably wasn't. Let's think of another example. Me and Katerina, we like coffee. We might go to Starbucks on campus. When we get there, we see a queue of 5 people. Do we push to the front? Would you push to the front? I want me coffee. You're not breaking any rules or laws, are you? There's no regulation to prevent us going from the back to the front of the queue, except from public interest and society. In a very British way, people would just probably tut at you. And let's be honest, no one likes to be heavy tutted, right? So we all stand in that queue being very British. But that's a British convention that's been made in the public interest. And that's not regulated at all. Not regulation, just pure public interest is the reason why we stand in queues. But on the broader context, the public interest is the voter. If a government creates regulation or laws that we don't like, quite frankly, we'll boot them out in 4 years' time. Well, in the UK we would. So the public interest is obviously quite a political issue. Who decides public interest? I suppose it's the government at the moment. But obviously we're the voters that we can change that in 4 years' time in the context of the UK. But obviously we do have kind of objectives in mind. From a economic regulation, we want to prevent monopolies happening. Now obviously there is natural monopolies, such as rail and water. We couldn't just all of a sudden create a railway because of the kind of costs involved. But if you think about on the last elections in the UK, one of the parties was looking to kind of nationalise the railway, creating technically a government monopoly. Now, I'm not saying that's the sole reason this party didn't win, but public interest might have not wanted that to happen, thus it being a political thing. So one party was saying, we'll create a monopoly, and the public interest were like, no, we don't want that, and that party didn't win. So you could argue, from a political point of view, that's how regulation works. But mainly, it's kind of like social regulation. We don't want desirable outcomes to happen in society, quite obviously. In the finance sector, before the financial crisis, we had the likes of Alan Greenspan, who was the chair of the Fed in America, praising the industry for creating the subprime market, which was not regulated. He was saying it's great that this subprime market is allowing people that don't get credit to buy a property. How good is that? And he was praising this free market, no regulated product. Well, let's be honest, these comments didn't age well when he was saying this in 2008. Because later on that year, what happened? It was found out that these desirable products that were giving people free access to capital to get a property was a house of cards. And it created, obviously, a very undesirable outcome where these people that were getting this great product then all of a sudden didn't have a house or have a job. So regulation was then put in place to prevent this self-regulated subprime market to be a very heavily regulated market. And that happened because the public interest didn't ever want this sort of thing to happen ever again. So hopefully that gives you an idea of what in the public interest means to prevent an undesirable outcome within an economy. Thank you, and we'll conclude this lecture, part 1, here. Hi there, and welcome to the second part of this regulation lecture. In this part, we're going to really talking about the actual infrastructure in the UK when it comes to regulating the financial services. However, quite a lot of this does emanate to other jurisdictions around the world. And keeping with the theme, we'll say this bit is more rules based because I'm going to kind of tell you what the rules are, a bit more factual compared to the first part, which was very principles based, where I had lots of rhetorical questions and examples. So in the UK, what does the regulation of the financial services sector look like? Well, following the financial crisis, we had the Financial Services Act of 2012. And this basically abolished the Financial Services Authority, FSA, which came into power in the Markets Act of 2000. So prior to this act in 2012, the Financial Services Authority was the only regulator, the main regulator in the UK for the financial sector. And as you can imagine, they were heavily criticised because they were in power since 2000, all the way up until overseeing the financial crisis. So there was a lot of criticism of were they asleep at the wheel, or was it not a good idea having one regulator trying to do everything? And this obviously comes into part of the idea of why the Financial Services Act came about. It was to abolish this authority and create, well, effectively 2 new authorities, but also created another committee within the Bank of England. So as you can see there, it created the Financial Conduct Authority, the FCA, and the Prudential Regulation Authority, the PRA. But it also introduced the Financial Policy Committee, and this is a committee within the Bank of England whose role and mandate is to identify, monitor, and take action to reduce or remove any systemic risk with the view to protect resilience within the UK financial system. So this is kind of a committee that sits on a regular basis to identify such actions, and obviously at times of stress they become pretty influential when it comes to policy. But these are like a similar committee to the committees we already have, like the Monetary Policy Committee, who set interest rates in the Bank of England. But the majority of the rest of this lecture will focus on the 2 authorities that were created, the FCA and the PRA, and the difference between them. So, This system is what we actually call the twin peak system, where we have two bodies, one that kind of looks after the market and the players and how they interact, and then one looks after the conduct of the individuals within the market. Now this is a bit different to the likes of the US system. So they have the Federal Reserve, but they also have a range of bodies that regulate each individual sector. Now again, post-crisis, they did a review, and I think at the time they had at least 6 different authorities. They had a review, and that review suggested 4. I think they ended up with 5. So they tried to kind of cut out the regulation authorities, but they didn't really reduce it in scope that much. And the problem with the US system at the time was when you regulated based on the business, the banks became too complex. So they had like a regulator for the security sector, they had a regulator for the insurance sector, they had a regulator for the investment banking sector. The problem came was when the banks, as you can imagine, had all 3. So which regulator took precedent? Which regulator did the bank listen to? Because technically, if their business model had all 3 entities, then they were regulated by all 3. And there was kind of no oversight or overarching regulation. So the rule really was you are regulated by the regulator which accounts for the most of your business. So if you were a retail bank, but you still had an insurance arm and an investment arm, if you're majority retail, the main regulator would be your retail regulator. But they didn't really have any jurisdiction over the insurance arm or the investment arm. So you can imagine the bank's business model shifting and changing depending on who their regulator was. And to some degree in the US it has changed, so it did abolish some of that, but there's still that kind of conflict of interest of which regulator do you try to satisfy. And the regulators didn't really communicate with one another as such prior to the crisis in the US, which led to further confusion. So you can imagine why we have this sort of twin peak approach in the UK now, rather than going for a range of different regulators for different sectors, just like the US system. So, as noted previously, we have the Financial Conduct Authority. Now this is a more independent body. The Prudential Regulation Authority, however, is the Bank of England. So the PRA, the Bank of England, and that's where they sit, but the FCA are not. They're a bit more independent. And independent of government as well, I should add. But the best way to describe how this system works is the second bullet point. Banks, firms and insurers are subject to supervision by the PRA for prudential issues, while any conduct risk or conduct of the players is managed by the FCA. So what do we mean by prudential issues? Well, this is the more market level stuff, the interaction between banks, the level of risks the banks take, and the level of transparency. The conduct risk, which is what the FCA are interested in, is the people and the players within the banks and firms. So it's the FCA's job to authorise individuals, to authorise the managers. And before these two came about, under the FCA, really the likes of conduct and some of the prudential issues were really kind of a self-regulatory structure. And as you can imagine, the self-regulatory structure didn't really work. You think about conduct, going back to part 1 when we were talking bankers' bonuses as the example. Well, that was quite self-regulated. Now, I'm not suggesting now that bankers' bonuses is regulated, but it's in the public interest. And the conduct of the board or whoever decides on the remuneration is more regulated than it was in the past, thus reducing the likes of excessive remuneration. And the lack of excessive remuneration potentially lowers the risk of moral hazard from the conduct of individuals creating excess risk to get higher bonuses. So let's just focus here on the Financial Conduct Authority. Now, I said these regulate the conduct. If you look at their responsibilities, this is taken really from their mandate. They're responsible for the business regulation of firms and how they conduct its business. But look at the second line. It's also responsible for prudential regulation of the firms that are not regulated by the PRA. Now, what does that mean? Well, this does refer to the PRA's mandate as who do they actually regulate. So there is some certain sectors out there that don't really fall under the remit of the PRA and I suppose do fall under the remit of the FCA. Now, I'll let you do some research into which organisations do fall out the realm of the PRA. And the clue is, think of people that are not potentially regulated by the Bank of England, but do have financial interests or sell financial products. So they're not really big players in the banking sector. So they're not big enough, essentially, to be regulated by the Bank of England. So use that as kind of a clue. Now, the objectives of the FCA is for fairness and efficiency. They will say is to promote consumer confidence, to ensure that there's levels of integrity are withheld within the financial system so that we know as customers that our savings products are protected and the people that look after our savings conduct themselves in an appropriate manner. But they also have an interest in ensuring a free and non-monopolised kind of market. But there's also an issue here when it comes to the banking sector and competition, because we have in the UK we have a competition commission or an equivalent name who looks at the likes of merger and acquisitions and then decides if that's going to disadvantage consumers and may prevent that from happening. But what you'll have seen during the financial crisis is that there was forced mergers, forced by the government for safety reasons. i.e. if the bank went down, then that would have a greater harm on society than if we created one larger bank. So the FCA do have a mandate to ensure fair competition, but there's also kind of a conflict with the Competition Commission here when it comes to merger and acquisitions of banks. Now, post-crisis, we haven't seen many merger and acquisition of banks. We have seen a merger and acquisition attempt from the London Stock Exchange, trying to merge with the DAX in Germany, but that was actually rejected by the regulators because of the size of the clearinghouse it would have created. It would have created a big monopoly on the clearinghouse side, and there would have been too much financial assets in one body. But whose decision was that? Was that the FCA's? Was that the Competition Commission? But let's complex things more. Was it not the decision of the EU and or the European Central Bank, because it was cross-border? So despite us having these kind of objectives in the UK, when we start getting to the nitty and gritty and we actually talk about banks, then they cross borders. So how does that work? And that's something we'll come on to at some other point, potentially in this module, if not next year, when we start talking about macro-prudential regulation and overall overarching bodies that kind of set the standards for individual jurisdictions to abide by. So very quickly, the banking sector has the Basel Accords, which has 27 jurisdictions, the UK, the US being two of the bigger ones. So they kind of set the rules or the principles, then individual countries have to kind of apply them. So there is a higher body that says this is how banks should operate across the world, and then they pass it down to individual jurisdictions to put that in place. And the speed of how regulations are put in place differ around the world. So Saudi Arabia is also part of Basel. They were able to get their Basel Accords in place very quickly because their legislative process is more streamlined. But the likes of the UK, which for Basel reasons falls under the European Central Bank jurisdiction, and that's took to create law that way is a much longer process. So I hope from this little example you get a kind of understand of how complex regulating the financial sector can be. Some more information now about how the FCA actually works. So as you can see there, they're the sole regulator of conduct, but this is the conduct of the firms that have been authorised by the PRA. So the Prudential Regulatory Authority authorises firms to operate in certain markets, but it's the role of the FCA to conduct the people within them authorised firms. The FCA actually have statutory power to make and enforce their own rules. Quite a lot of the rules that the FCA make tend to be driven from their objectives, also for public interest. And the FCA tends to pride themselves on being a more proactive regulator, so they try and foresee issues that could harm consumers before it actually happens, to take effective steps before such events occur. Now in practice, I don't know how true this is, but typically quite a lot of financial regulation is a bit more reactive. So something will have occurred and then something will be put in place to prevent it from happening ever again. And later on in the module, we'll kind of talk about some of the rules that the FCA have created when it comes to like advertising or the conduct of individuals and how you can be authorised as a participant within a authorised firm. And despite the FCA trying to be proactive, quite a lot of the examples really are reactionary, and only recently they've changed how individuals within a bank are authorised, because to work in management you have to go through what was known by the Financial Services Authority as a fit and proper person. But only recently, last year, that's been overhauled. It's very similar, but the characteristics of getting authorised and the name is very different. But going back to the first slide, the FCA was from the 2012 Act and in place in 2013. So it's took them a good 7 years to change how individuals are authorised. So when we talk about the FCA and how it creates its rules, well, this is another bit of terminology. It creates these rules on a risk-based approach. So we've talked about regulation, and having potentially too much regulation can actually harm institutions from operating efficiently. So then you have a bit of a balancing act of too much red tape being harmful, but not enough being not in the public interest and creating undesired impacts. So essentially what the FCA do is they try to identify emerging risks that us as consumers may face. They'll weigh that up and say, if it's too much risk for consumers, then they'll prevent that from happening. When they authorise a person, they will look at this person's history and potentially say, are they too risky to work in this sector? Now, an example we will use is, for instance, someone that was bankrupt in the past. Should they be authorised to look after someone else's money if they couldn't look after their own in the past? So we have to weigh up them risks. When creating rules, they also have to think of, do these rules exist elsewhere? Is it conflicting with other standards set? When creating rules, has there been a precedent in the past? Is there evidence of this sort of rule working? Now, this doesn't have to be a rule that exists in the UK. They might look overseas and go, well, actually, they've got such and such rule in place. What's the evidence of it working? Can we adopt it here in the UK without any issues? And then finally, it's their role to lay out the infrastructure of how to implement these rules and give timelines on when these rules will be introduced and how banks should actually follow them and be transparent and open to explain how they follow potential rules that are being created under this approach. So when they've taken this risk-based approach to creating the rules, then these rules, known as rules-based regulations, are black and white. And these are kind of the characteristics we would suggest would possess. So just see it as kind of box ticking. Have they complied with this? Yes or no? Rules-based is you have to follow them by the letter of the law. There's no real discretion. This is the rule, you must follow it. But the key principle you should note from this is that rules-based approach stick to the letter of the law rather than the spirit of the law. So that's the terminology we should remember when we're talking about rules-based regulation. Now, of course, rules-based has its advantages. It's pretty black and white. It's yes or it's no. It's easy to understand, pretty clear. You know if you're breaking the rule or not. And for that point, it's easy to follow and apply. But the disadvantage there is what we're talking about in the first part, the greyed lines, where potentially one size doesn't fit all. It's too robust. It doesn't work in certain sectors. With the financial services sector and individual banks being large and complex, it might be very difficult to apply these rules to every single institution because it might hinder how they operate compared to someone else. And in some aspects, these rules could then become kind of clunky and might be rendered pointless if they're not applied properly. So what is principle-based regulation? Now, this is the grey area. This is where kind of the principles are laid out, and then it's up to individuals to interpret what that means. So going back to the first part where I said a principle at the moment is hands, face and space. Now we understand that's a principle. I guess we understand what that means. But I can guarantee you I might interpret that slightly different to someone that's watching this. But that's the principle. It's kind of easy to understand on the surface, but when we dig in, well, actually, I might consider space something different to that you consider space as. Thus, the disadvantage is being it's very subjective. It allows a lot of discretion, and we can interpret it very differently. But then this could satisfy over rules-based because the one-size-fits-all approach previously is kind of removed because you can tailor this principle to the size of your firm, the way your firm operates. But then that could cause a headache for regulators because individual institutions may then apply this principle very differently, purely based on their size. Now, is that fair? Is that transparent? So let's use an example. Now this is very timely, as last week you'll have seen in the news the FinCEN papers were released, which were papers that authorised firms, specifically from a US regulator, had to provide to the regulators to identify that if any sort of money laundering transaction was going on in the bank, then they had to acknowledge this and provide it to the regulators in confidence. So the regulators can then see what sort of suspicious activities the banks have identified within their institution. But the problem with this FinCEN papers is the banks were then kind of criticised for not acting on the suspicions that they highlighted. But one would say, well, hold on. Under the regulations, we have to provide these documents to the regulator, and that's what we've done. We've actually provided the documents in confidence. So the banks did what they should have per the regulation. However, the argument is about other rules and regulations when it comes to money laundering. Now there's laws in place to prevent that. And since the leak of these documents, which should have been in confidence, there's been an argument about enforcement. Whose job is it to enforce it? Is it the banks? Or is it the legal authorities in the countries? A specific example from them papers was HSBC, where they reported to the US authorities that they'd identified potential money laundering regarding transactions of a Ponzi scheme from the likes of investors in the UK and America, and then the funds being transferred through HSBC's different branches to end up to the Hong Kong branch. Now the banks are identified that these transactions are potentially money laundering from the proceeds of crime. But then under the money laundering rules, which we'll cover in this module, the banks are unable to tip off their customers. So if you're suspected of money laundering, the bank can't tell you that they suspect you're money laundering. You have to pass on the information to the regulators and the legal authorities in that country. So all the bank can do is turn around to said customer and say, sorry, your bank account's currently facing a few issues, technical issues, or make up something excuse or something we're looking into or something like that. They can't say, oh yeah, we'll report you for money laundering. And the scale of these transactions were in the billions. So how long can HSBC keep going to this customer that was trying to money launder? Sorry, there seems to be an issue, something. Because clearly the customer will then realise, hold on, we're being found out here, and then they'll potentially try and withdraw the money or something. But then again, the large sums of money involved, HSBC, now I'm not suggesting they're thinking this at all, but that's a big customer they could potentially lose, and all that money could go to another bank. So HSBC could potentially still allow this to happen while they're waiting for the regulators to intervene. So there was another argument that, like the UK, the National Crimes Agency didn't have the resources to actually intervene and investigate these claims that HSBC had acknowledged. Therefore, the bank had really no option but to continue allowing the flow of money from its UK branch to its Hong Kong branch. So who's at fault here? The banks reported this activity, but the legal powers didn't have the capacity to deal with it in a timely manner. Therefore, HSBC can't lose a customer because it might actually not be money laundering. It's only a suspicion. But obviously these papers were sent to the US authority. So what did HSBC send to the UK authority? And what's the cooperation between them? So going back to this example, a rule stipulates that firms must report any transaction over a certain amount that's suspicious. Well, HSBC, I'm assuming, did that. But the principle would be an authorised firm must report any transactions that they have a reasonable evidence to suggest that this is suspicious. But if you look at this rule again, for suspicious money laundering transactions, right, well, what constitutes as suspicious? So within that rule, that word suspicious requires the bank to kind of have some sort of principles or some sort of standards to what actually constitutes as suspicious. So all of a sudden this rule-based has become a little bit subjective, and we have to go with the principles, or we have to look at kind of historical transactions to work out what might be a bit more suspicious than what would normally occur in a day-to-day activity. So this rule has all of a sudden become quite blurred. But just from them two definitions there, you can see the complexities between what is a rule and what is actually principle-based. Now, there's obviously very good arguments for having principle-based regulation. In the fact of that recent example, quite a lot of the rules have to be interpreted somehow, and how do we interpret the rules? Then it's probably based on our previous experience or the context in which that rule is based, which is subjective and kind of links to principles-based regulation. If we go back to this example again, now, personally myself, I don't have a large amount of wealth, so me shifting £10,000 might seem suspicious. But if your customer has a high net worth, then them shifting £10,000 probably not suspicious. So within the rules-based context there, which example, me or the high net worth, would the bank then report to the regulator? They'd probably report me because that's more suspicious, because I don't do that very often. So that's where the likes of the one rule doesn't fit all sizes. And as a customer, I wouldn't think that's fair. I've shifted £10,000 because I've just put a house deposit down. That's not suspicious, I've just bought a house. But this rule would potentially make it suspicious. So that's why the likes of this principle-based might be more appropriate. It's more flexible, it suits the scale of the problem involved. But saying that, there is certain limitations to principles-based regulation, as you can imagine. We can't have principle-based all the time. There's laws in place. Laws, obviously set in the public interest by regulatory bodies with the power to enforce them. So them are pretty black and white. And some things that are law enforcement have to be rules, or they could have cases of anarchy and civil unrest if there was no rules and everything was kind of principles based. And that's simply because principles are not enforceable. Going back to the example of hands, face and space, as a society we have to enforce them ourselves. But what we'll have seen very recently is the government have decided that hasn't really worked out as well as they planned. Therefore, they'll put enforcement in place in the form of legal penalties and fines. So what was a principle very quickly turned to a rule in some areas. And also, when you come to principles, because of the subjectivity, then some institutions may think they're being unfairly treated if they interpret a principle very differently to another institution. So for competition purposes, someone might be a bit more laissez-faire with the principles, which might generate more profits, making them more competitive compared to someone else who takes the principles more strictly and may lose out. And then that doesn't really promote fair competition, which is one of the objectives of the Conduct Authority. So if we look at the definitions here in a table, you can see this rule, there's a criteria set out, it's a quantitative measure, it's given a specific amount of money, but in the principles it doesn't specify £10,000. It says what you think is suspicious or what you think is a reasonable amount that would cause suspicion. So we look at the table underneath. As you can see, rules-based, very objective. Principles-based is subjective. Rules-based is, that's the rule, black and white. It's easy to apply and pretty simple to do so. But with the principles-based, It's highly subjective. It has a lot of freedoms, flexibility. They can be applied quite quickly because it's individuals' common sense, and they potentially don't have to go through reams of documents to work out how to implement these principles because you do it on a localized basis. But because it's principles based, it's up to the market to put these in place. Therefore, it's under the assumption that the market has a higher knowledge about its own sector and able to put in principle-based regulation. And this also comes to the argument about hands, face and space. You could argue that the population are not all scientists. Therefore, we can't fully understand what these principles actually mean because we don't have the full knowledge to do so. Now, let's look at the PRA. As I mentioned before, they're the part of the Bank of England, and they focus specifically on authorising the firms to operate and the levels of power and influence individual firms can have within the market. So in the UK context, it's their job to look at the potential regulation of the banks, the building societies, credit unions, insurers, investment firms. And throughout this module, when we ever talk about financial institutions, we're really talking about PRA authorised firms. And as noted before, these firms are authorised by the PRA, but the conduct is also regulated by the FCA. Now, within the Bank of England, the PRA has two statutory objectives, and that is the safe and soundness of the firms. So it's looking at the overall risk of the firm and the risk behaviour of the firm, not individuals. But the second objective is to facilitate effective competition. Now hold on, we've just said that's the FCA's role. So that goes back to the argument I was mentioning before about competition not just being a one authority objective. Now I know I said there's two statutory objectives, but there is a third one there, but that's really specific to the likes of the insurance sector that it also regulates. And how does it achieve these objectives? Well, it sets the standards and a certain limit, but quite a lot of these objectives and these standards are, as I've said, kind of predetermined by the higher regulatory body of the Basel jurisdictions. So it's the PRA's role, the Bank of England, to administer and implement these sort of standards that have internationally been decided. Now, their approach to the regulation isn't it's more judgment-based rather than risk-based, like the financial conduct authorities. They make judgments on the safe and soundness. Really, these judgments are from historical evidence, so they'll require banks to do stress tests on various scenarios that would have happened in the past, and then they can create new rules and regulations based on the performance of stress tests, and if they foresee any issues in the economy moving forward, like for a recession, then the PRA can make a judgment on any additional regulations that are required within the sector on that. So they try to be forward-looking as well by looking at past trends and stress tests and potentially forecast what's going to happen moving forward. And this is where they heavily link with the Financial Policy Committee when they're talking about the likes of stability in the UK, and that stability within the banking sector also relies on the PRA's communications with other regulatory bodies from other countries on the stability of their banking sectors. And to be fair to the PRA, since they've been created, we haven't seen a major stability issue in the UK. Even with the likes of the Brexit vote and the coronavirus, we still haven't seen a major banking stability issue despite these. So there's good anecdotal evidence at the moment that they're doing a pretty decent job. They also have statutory power. Enforcement action, as noted, is rare, and arguably at the moment there hasn't really been a need for enforcement. We've only had a few banks that have failed their stress tests that have been set out, and where that's happened, the PRA have obviously stepped in and required banks to get themselves in shape to pass future stress tests and potentially do additional supervision to make sure that then banks have the right level of support and capital in case anything was to happen externally that would impact the banks. And as you can see there, the PRA does have statutory power that can compel firms to address any issues. However, seeing that there is still an issue of this too big to fail concept or too big to regulate concept. For example, the likes of HSBC, not from these FinCEN papers, but previous examples of money laundering in case of Mexico, then technically the PRA has the power to withdraw HSBC's banking license. But it wouldn't do that because in the consumer interest, you can imagine if a regulator turned around to HSBC and said you can't operate anymore, you can imagine the public interest to that and the wider implications to the economy and its people that would cause. And because the PRA is part of the Bank of England, technically it has a few more powers above the FCA, so it can veto any decision the FCA makes and has a bit more power to them in that sense. It has also additional powers where it can step in and investigate market players, and it can serve warnings to the public about certain banks if it chooses to. Now, earlier on I did send you a task to do research on who is not authorised by the PRA, but here's an example of who are. Pretty much most banks, building societies, credit unions, insurers, the Lloyds of London who look after the insurance market, and investment firms designated by the PRA. So there is a long list of firms who are authorised by the PRA, but this is where you can have a look to see who isn't. Now a clue is it might be on your apps. There's quite a lot of fintech companies or trading platforms that potentially do not fall under the remit of the PRA, but we have access to them via the internet. So there's a few examples where the PRA don't get involved, and some of these companies are not even authorised by the FCA. So if you ever do have these apps, do have a look, see who authorises them. Quite often, it might say the FCA, probably won't say the PRA, but it might say a regulatory body from another country, and that'll be where they're based potentially. As well as these two regulators, in the UK, I've mentioned before, we've got the Competition Commission, the Markets Authority, who look after the well-being of all sectors, not just finance, so any merger and acquisition. So in the supermarkets, this is the body who gets involved, but as you can imagine, they will also be involved in any merger and acquisition of banks or financial firms. But as noted before, this is where the blurred lines are, so who has the final say. We have the Information Commissioner, who obviously, as you know, is in the public interest when it comes to data, and they have the GDPR regulations, so the banks obviously have to adhere to them. And again, when it comes to information sharing between the banks and the regulators, does that infringe GDPR or any rules that the Information Commission come out with? Within finance specifically, now the banks do hold our pensions and deal with our pensions. There's a whole kind of regulatory body around that. So again, is there a conflict of interest between kind of pension protection or the FCA and how banks conduct the administration of pensions? So is there any conflict of interest between them two in the conduct of anything related to pensions? But again, there's even wider. I'm not going to go through them all, but you can imagine there's the government involved, the taxman, you have the Financial Services Compensation Scheme, you have the Financial Ombudsman, who are the body you'd go to if a complaint from the bank doesn't have a satisfactory outcome, you'd then go to them. What's the link between the Financial Policy Committee and the PRA? Then you have the Bank of England and its other various departments, as well as the the PRA. And then, of course, you have the Treasury. And lastly, for this section, we'll talk about some of the challenges. Now, since they've came into power, I have mentioned that there hasn't been any real major challenges. We've not had a major recession up until now, but as you know, the banks haven't really made the news yet. I say yet, because they've been stress tested for the scenarios like this, or kind of big falls in the stock markets and the economy. So the banks are in a pretty decent shape at the moment compared to what they may have been if these regulators weren't in place. Certain sectors, like the insurance sector specifically, there's a bit of a confusion or the walls between who regulates what. Because we don't have one overarching regulatory body, there could be lacks of communication between the PRA and FCA. Now, there haven't been too many public issues of this ever occurring, but the two separate bodies, they're meant to be independent, so there's always scope there for issues in communication and conflict of interest. And there's also potential issues between the FCA have kind of a risk-based approach to creating rules, but the PRA tend to use more judgment and historical evidence. That kind of mixed bag approach from the two regulators could kind of be seen as not consistent. But even coming down to the likes of an operational level, when we're talking about authorization of individual staff, this tends to be staff at like higher levels or staff that have certain levels of power, not the kind of customer service representation. It's the FCA's role to manage their conduct and make sure they're suit and proper, but the PRA do stipulate a range of kind of policies, procedures when it comes to training and certain requirements of individuals, and how does that conflict with this fit and proper persons equivalent from the FCA. So kind of a bit of blurred lines there when it comes to individual staff and the promotion of certain colleagues at the higher level. So there is a few challenges between these two Twin Peaks approach, but at the moment these challenges haven't really materialised into anything substantial in the form of any banking crisis or collapse of a financial institution. And on that note, this is where we'll end this second part. Hi there, and welcome to this third and final part of the regulation lecture. So far, we've looked at what is regulation, what the difference between rules-based and principles-based regulation is, and we've looked at the UK regulatory infrastructure and talked about the differences between the FCA and the PRA. In this final section, we're going to look at the principles of good regulation and how firms can support regulators in achieving good regulation. So, we have 8 different principles of good regulation. Now, these are not specific to the finance sector or specific to any regulatory body. These could be for really the introduction of any regulation. So it's more reaching than that. But obviously the examples I may use will be in the confines of the finance sector. So firstly, we want them to be efficient. So what does that mean? Well, effectively, you don't want regulation that is highly expensive to implement, therefore hampering the business. Good regulation should be there to let things run smoothly and really not be red tape or hamper any sort of growth in the industry. And ideally, when creating new regulation, hopefully this new regulation can already utilise the resources the banks already have, rather than having to create a whole new, department. So we'd like regulation to be efficient. Regulation should also be proportionate. There's a saying, you should never crack a nut with a sledgehammer, because that's kind of overpowering things. So any sort of regulation should really fit the purpose that it's trying to suit. It shouldn't be an over punishment or too much of a burden for the firm to implement. And this also links back to the likes of efficiency. There's also sustainable growth. The idea of regulation, certainly in the finance sector, is to help the sector grow. The likes of safety regulation for risk taking is not there to prevent banks from creating wealth, but it's there to design them to create wealth in a sustainable way so that they don't issue the likes of subprime mortgages all the time to generate extra income and extra wealth, but they issue loans that are safer, which is a more sustainable way of creating wealth. Now, of course, banks do issue riskier products, but regulation's there to ensure the banks have enough capital in case that loan turns into bad debt. So it doesn't hamper the stability of the bank and helps them sustain a certain level of capital. The next one is about consumers' responsibility. In a capitalist society, consumers have choice. They take responsibility for their actions. So regulation should acknowledge that consumers do have a choice in the market. If a consumer chooses to take a mortgage that's 5 times their income, then it's the regulator's duty to make the banks inform the customer of their risks. But at the end of the day, if the customer accepts the risks of this large loan, then the bank can say to the regulator, we provided all the relevant information to the customer, and therefore they took on this risk, and we were satisfied that we'd fulfilled our regulatory requirement to inform them, because over-regulation could potentially hamper consumer choice, and we wouldn't want that. Also, good regulation should accept that the management of these organisations have a certain level of responsibility to their own stakeholders. But this also means that the regulators kind of delegate the responsibility to the senior management to set out the principles or the rules within their organisation, rather than the higher level rules being applicable to every single person in the institution. So the regulators have to work with senior managers to make sure they take the responsibility when it comes to the regulation setting and adhering within their own organisation, and not leave that burden to other or all staff. Another principle of good regulation is the recognition that businesses are very different. So in the financial services sector, you have the likes of banks who have shareholders, you have building societies who have owners, and more like stakeholders. So these two different types of institutions do serve the same purpose, i.e. providing retail banking, but their objectives and aims are very different. Some banks might be more profit-driven, like building societies are more community-driven. So regulation has to satisfy that businesses have different aims and objectives and serve different people, and that one-size-fits-all sort of regulation might not suit. Good regulation should be open in its disclosure, so regulators should publish relevant information to the market and provide information about regulated persons. And this could be in the finance sector, to ensure stock market efficiency, and any sort of disclosure should be made in a timely manner. And the last principle of good regulation is transparency from the regulator. So transparency in the way it operates and how it produces regulation, and potentially the choice of consultation with the sector. So when a regulator creates rules, they may put a consultancy paper out there to get the likes of the sector to come back and say how these rules will actually impact the banks and potentially help the industry in the creation of regulations. So, how can the firms then support the regulators in achieving good regulation? Now, these points are kind of taken from the FCA framework of how they categorize different sections or departments within firms. So firstly, how can the management and senior management of a business help the regulators in this process? Well, as mentioned before, it's up to the managers to ensure that regulations in their organisation are adhered to. So senior management should look at these rules and then kind of set the good standards of corporate governance and the culture of the business in line with complying with any regulatory requirements that are drawn up. A big element of ensuring that regulations are adhered to would really come from the compliance department of any bank. So a compliance department, it's their job to ensure that any rules and regulations that the business is subjected to are then followed. So it's up to the compliance department to set out the policies and procedures within an organisation, and also a mechanism for reporting where the likes of any crime or whistleblowing or any sort of conduct issue that hasn't been spotted. It's the compliance department's job to ensure that these are in place. And it's obvious that a compliance team should have the relevant expertise. So, for instance, the money laundering officer within a financial institution should have the necessary qualifications and experience to be given this really high role and a legal role when it comes to money laundering. And it's also the role of the compliance function to ensure that their staff in the organisation have the adequate training and the time to understand the rules, and if they have any questions, it's up to the compliance team to ensure that there's a mechanism for continuous professional development. But as well as compliance, you'll have the risk management functions within a firm. So the likes of the Asset and Liability Management Committee will look at interest rate and liquidity risk within a bank. But you'll also have like the operational risk desk, who will look at the various internal and external operational threats. So the risk management or the risk managers, it's up to them to set kind of the risk tolerance, the methods of calculating levels of risk, and potentially provide information to managers on how this should be managed. Another function is the finance function, or you could say the treasury function in a bank. It's their duty to ensure that if it's for customers, that customers are properly credit checked. Banks must know their customer, so get the appropriate documentation to ensure that customers say who they are, so they can't be seen to allow criminals to operate within their bank. It's also up to the finance or treasury department to ensure that there's proper record checking, so when it comes to the likes of producing financial statements, to make sure that they have all the information that's appropriate to produce accounts that can be audited correctly. Another function is the kind of internal auditing, external auditing, and the legal department. Now, the role of the independent auditor is to ensure that the reports that have been created are fair and accurate reflections of what's actually happened. But before we get to the external, all processes and transactions should be internally audited to ensure that these policies and procedures the banks have done are in line with the management's own policy setting. And then finally within here we have the legal advisors. Now obviously the legal advisors' role is to ensure that the banks don't fall foul of actually legislation or the likes of case law, with the view to ensure that the bank does adhere to any regulation set. And then the last function is the client money and oversight function. And this is the function that's really in charge of ensuring that customers' assets are safe and secure, and that there's potentially enough capital in place or enough liquidity in place. So if there was a run on the bank, that the bank would have enough in reserve to ensure that it can fulfill its requirement to its customer without causing panic or a bank run in the extreme case. And it's also up to this department to ensure that its customers have confidence in the organisation it stores its assets with. And the way that this department can do that is to advertise its regulations that it adheres to and provide information on what the regulations are and who authorises it. And all of this sort of promotion will be seen as a sign of strength and that the bank adheres to good regulation. And thank you. And that now concludes the regulation lecture for this module. So as I noted in the week 1 introduction, the things we want you to do now is look at the Financial Times, get signed up on that, review this lecture content, have a look at the FCA and the PRA's website, and that will lay out their kind of aims and objectives and potentially some nice user guides or videos about what they actually do. I've got a YouTube video up there for you to watch, and also on the Blackboard site there's a link to a two-part documentary about the inside of the Bank of England that came out last year, so I'll give you a good idea of what the Monetary Policy Committee do, which I haven't really talked about much, and then it'll tell you how the bank does operate and its role within the different regions. And then lastly, there is a multiple choice quiz to give you an idea of where the current knowledge levels are and some ideas to do background research into this area. Thank you very much.